Today, we are cracking open a subject that has, well, it's defined history, it's fueled revolutions, and it absolutely dominates political debate right now. We're talking about the long-term historical dynamics of wealth and income.
And our mission here is, I think, simple but also really challenging. We're going to take a 15-year stack of rigorous historical data.
The kind of evidence that really cuts through the noise.
Exactly. And from that, we want to extract the fundamental laws that seem to govern inequality. The goal is to move beyond just opinion and get into the facts.
That's the key, right? Because when we talk about inequality, the public conversation tends to generate just an enormous amount of heat.
And very little light, largely because it's often fueled by what the original research calls a paucity of fact. We're looking at a huge body of collaborative work, starting back in the late 90s and going through about 2013, with really foundational contributions from scholars like Anthony Atkinson and Emmanuel Saez.
Especially on the U.S. data, right?
Yes, especially on the U.S. case.
So we're not just looking at recent trends, we're actually mapping 3 centuries of economic movement. The goal isn't to, jump to political solutions right away, but to first understand the core economic mechanisms.
The things that cause wealth to either concentrate or to disperse.
We're looking for the economic physics of distribution, in a way.
And to start, you really have to acknowledge how haphazard the early debates on this were.
Yeah.
I mean, before the mid-20th century, if you wanted to understand wealth distribution, you didn't look at tax returns.
Those records barely existed.
Right. You looked at novels.
It's fascinating, isn't it? Relying on literary sources, Balzac, Austen, Zola, for what we now consider, hard statistical analysis. People had this intuitive knowledge from just looking around, but they couldn't quantify it.
A perfect historical example of this kind of pre-statistical panic, is Thomas Malthus.
Malthus.
His famous 1798 essay on the principle of population is often viewed through this purely economic lens, but its context is deeply political and it's observational.
And he was heavily influenced by the travel diary of an English agronomist, a man named Arthur Young.
That's right. Young was traveling through the French countryside in 1787 and 1788.
So literally on the eve of the French Revolution.
Exactly. And he reported back on the crushing, just pervasive poverty he was witnessing.
And Malthus took that observation and put it into a demographic context, because France at the time was the behemoth of Europe.
Oh, absolutely. Its population had just surged from about 20 million in 1700 to nearly 30 million by 1780. And this rapid growth, without the agricultural technology to support it, had devastating consequences.
That demographic pressure created a classic resource squeeze. It directly led to the stagnation of agricultural wages, too many workers, while at the same time driving up land rents because land was the scarce resource.
And the structural tension, the immense wealth of the aristocracy based on those rents versus the stagnating wages of the masses, it made the aristocracy incredibly unpopular.
A situation that directly fueled the 1789 revolution.
And the political ideas coming out of France in the 1790s absolutely terrified the European elite.
So Malthus's really extreme conclusions, his recommendation that the elite should cease all welfare assistance, even severely scrutinize the reproduction of the poor, these weren't just academic equations.
Not at all. They were born out of a genuine political fear that was gripping the entire European ruling class. A fear that their own stability was about to crumble under these revolutionary forces.
It's a profound lesson in how the study of economics often starts driven by immediate observation and political panic, long before the data can offer a clearer view.
That fear didn't just end with Malthus. It kind of solidified into what the research calls these dark or even apocalyptic views from the greatest thinkers of the 19th century. Think of David Ricardo and Karl Marx.
And they shared this fundamental, gloomy conviction that some small social group was just destined to claim an increasing, unstoppable share of the national output.
Starting with Ricardo in the early 1810s, he focused on what he called the scarcity principle. For him, the scarce asset was agricultural land.
Right. He feared that landowners would just inevitably claim a growing share of everything because, as the population grew, the demand for food, and therefore the rent you could charge for land, would stay perpetually high.
He basically foresaw a world where the landed gentry would choke off industrial progress by demanding these ever higher rents for the one thing everyone needed: space to grow food.
So why did the Ricardian apocalypse, this permanent rise of the landlord class, why did it never happen?
Well, he underestimated the sheer velocity and scale of the technological progress that was just starting to take hold.
The Industrial Revolution.
Exactly. Industrial growth and new farming techniques dramatically reduced the value of farmland relative to everything else. Agriculture's share of the economy just plummeted. For the first time, humankind started to free itself from what Ricardo assumed was this eternal, purely food-based imperative.
But here's where the source material gets really interesting. The scarcity principle itself wasn't wrong. Ricardo Giustelli, he applied it to the wrong asset for the long term.
That's the key insight. If we substitute 19th century farmland with contemporary scarce assets, the principle just snaps right back into relevance.
So instead of farmland, think, what? Urban real estate in major global cities.
Or natural resources like oil, or even intellectual property rights and patents.
And if you look at those new scarce assets, the trends from, say, 1970 to 2010, the rising cost of housing in London or New York, the concentration of oil wealth, when you extrapolate those trends out to 2050 or 2100,
you start seeing the Ricardian apocalypse reborn. It's absolutely there. We are currently facing massive economic and political disequilibria driven by scarcity in these new domains.
The inability of average wages to keep pace with soaring urban rents, for example?
That's a direct modern analog of Ricardo's fear. A small group of asset owners claiming an unsustainable share of total output simply because they own the ground people stand on or the energy they need to function. It drives social instability just like agricultural rents did 250 years ago.
Okay, so moving on from Ricardo to his intellectual successor, Karl Marx, in the mid-19th century. He shared the dark outlook, but he shifted the focus from landowners to industrial capitalists.
Right. Marx predicted a different kind of doom. He saw this principle of infinite accumulation. Industrial capitalists, driven by endless competition, would just accumulate ever-increasing quantities of capital.
And this massive, unchecked pile of capital would eventually lead to a falling rate of profit, which would cause economic crises and ultimately the violent downfall of the whole system.
He saw the system as inherently eating itself alive.
And yet history showed that the system was, well, more resilient than he thought. Wages, which were objectively terrible during that early industrial period, they did finally start to climb in the last third of the 19th century.
Marx, like Ricardo, neglected the sustained power of durable technological progress and steadily increasing productivity. These forces acted as a necessary counterweight to the concentration of private capital.
So every time the system looked like it was about to choke, innovation allowed for greater output and eventually slightly higher wages.
The sources are also pretty sharp in their critique of Marx's method, actually. They note that he suffered from having effectively decided on his political conclusions way back in 1848, the year of revolutions all over Europe.
Before he undertook the necessary historical and statistical research for Das Kapital.
Exactly. This tendency led him to issue what the research terms hasty pronouncements. The political conclusion came before the empirical investigation.
And arguably the most profound failure was his lack of detailed thought about what comes after. The political and economic architecture of a society where private capital is abolished.
He focused entirely on the critique of capitalism, but not on the structure of the alternative.
Right.
And this theoretical vacuum, this failure to draft a blueprint for a functioning post-capitalist economy, it left a colossal void. History shows that void was ultimately filled by what the research calls the tragic totalitarian experiments of the 20th century. The failure to offer a viable economic model contributed directly to immense political suffering.
So, if the 19th century was defined by these gloomy, scarcity-driven predictions, the mid-20th century just completely flipped the script. It ushered in an era of great optimism.
And that was largely initiated by the first great data scientist of inequality, Simon Kuznets.
Kuznets' 1953 work, Shares of Upper Income Groups in Income and Savings, was a landmark moment.
It was a total game changer because he finally broke free of that literary observation. He was the first person to try to measure social inequality on an ambitious national scale.
And he had access to two crucial sources that just didn't exist for Marx or Ricardo.
The first was U.S. federal income tax returns, which had started in 1913. And the second was his own estimates of U.S. national income, creating the first solid national account accounts data.
But his focus was quite narrow, right? Only the U.S. from 1913 to 1948.
Yes, very specific. And his findings suggested that income concentration had declined significantly between the wars, and especially after World War II.
And this finding, combined with that incredibly rapid, sustained economic expansion seen globally in the post-war era, what the French call the Trente Glorieuses.
The glorious 30 years, from 1945 to 1975. This was a period of massive post-war reconstruction, high productivity growth, and strong institutions. It fostered this widespread optimism.
The accepted wisdom became, inequality will naturally and gradually decline as a country develops. It was seen as a challenge to all those 19th century apocalyptic views.
The convergence was seen as this smooth, almost tranquil feature of modern capitalism.
Precisely, and this is what motivated the new research we're diving into today. Kuznets's optimistic view needed a much broader test, so our current sources deliberately broadened the scope.
Covering 20 countries and extending the time frame well into the 21st century.
And when you pull that lens back, when you get that global, long-term perspective, what did it reveal?
It radically challenged Kuznets' optimism. While there was convergence after World War II, it wasn't permanent. The wider data immediately revealed this vertiginous growth of income of the top 1% in the United States, starting dramatically in the 1970s and 1980s.
So the Great Convergence was actually an anomaly.
It was. Largely a temporary consequence of the unique shocks of the mid-century, not some inherent feature of market development.
Okay, before we delve into what caused that modern divergence, we need to get completely clear on the key terms, starting with capital. Because in this research, capital or wealth has a very, very specific meaning.
Yes, the definitions have to be rigorous. Capital is defined as the sum total of non-human assets that can be owned, exchanged, and potentially rented out or sold on some market.
So think real estate, financial assets like stocks and bonds, machinery, corporate equity,
Intellectual property, patents, all of that.
and the distinction we need to emphasize is the exclusion of human capital. Why is that so crucial?
Because the entire premise of a non-slave society is that your skills and abilities, your human capital, cannot be owned or sold on a market. The moment you start mixing human capital with financial capital, you lose the ability to analyze the specific autonomous dynamic of property accumulation that we're focused on.
So based on those definitions, the fundamental structure of the economy is expressed through two simple equations.
That's right. You have the flow side. National income is the sum of capital income. So rents, dividends, interest plus labor income, which is wages and salaries.
And then you have the stock side.
The stock side. National wealth equals private wealth plus public wealth. Though, as we'll see, public wealth is often insignificant or even negative.
It's historically fascinating that in the 19th century, the focus was entirely on that stock. Being an economist often meant estimating national wealth, this colossal accumulation of private capital.
Giffen in Britain, Fauville and Colson in France. Annual GDP calculations didn't become standard until the interwar period.
That historical shift from stock analysis to flow analysis is important. But the core insight of this research brings us right back to the stock.
Or rather, how the relative flow of two specific rates determines the distribution of that stock.
And this brings us to the core argument, the critical law of dynamics, the inequality RG.
The rate of return on capital, R, is persistently greater than the rate of growth of output or income, G.
This is the central destabilizing force that the research identifies. It states that over long historical stretches, the yield you get from capital, the dividend, the rent, the compounding interest, is higher than the rate at which the economy as a whole, G, is expanding, and therefore higher than the rate at which average wages are rising.
So what's the massive implication of this inequality? Why is it a spontaneous force pushing toward divergence?
Well, because when R is greater than G, wealth accumulated in the past grows faster than new wealth created through productivity and labor.
Let's make that concrete. Imagine a young person starting their career, saving 10% of their salary, where salaries are only growing at, say, 1.5%. That's G.
Okay.
Now compare that to someone who inherited a substantial portfolio that's earning 5% passively. That's their R. The inherited wealth is compounding more than 3 times faster than the labor-derived wealth.
The past quite literally devours the future.
It does. And the entrepreneur, the person creating new productive wealth, tends over time to turn into a rentier, someone who just lives off the stable returns of past accumulation, because those returns eventually outstrip what they can earn from their own labor.
And we established that historically, pre-19th century, this was just the norm. R was dramatically higher than G.
Oh, absolutely. Before the Industrial Revolution really took hold, R was typically around 4 to 5%, but G was often below 1% per year.
The societies of Balzac and Austin?
Exactly. Highly stratified, capital-dominated, determined by inherited wealth. Those societies arise and can only subsist in these low-growth regimes. Growth, in that context, offered very little social mobility.
And the disturbing projection for the 21st century suggests we are rapidly returning to those historical conditions.
That's the concern. Global population growth is slowing, productivity growth is slowing, and that's pushing G down toward 1.5% or even less, while R on capital remains pretty resilient at 4 to 5%.
This long-term dynamic is then reinforced by the second fundamental law of capital accumulation, which defines the size of the capital stock itself. Buddy is SG.
Right, where Buddy is the capital to income ratio, S is the savings rate, and G is the structural growth rate.
Okay, let's break that down for the listener. If the capital to income ratio is, say, 6 years of national income, meaning all the private capital in a country is worth 6 times its GDP, how does that law explain the structural shifts we've seen?
It shows that in the long run, the ratio of wealth to income is governed entirely by the interaction of saving behavior and growth. And the critical implication comes when growth slows down.
As it is now.
As it is now. If the savings rate, S, remains high, let's say 10% of income is saved every year, but the structural growth rate, G, falls, then the capital to income ratio has to rise significantly.
Give us the concrete example from the sources again, because this is a massive structural change.
Okay, if the growth rate, G, falls from 2% to 1%, and the society keeps saving 10% of its income, the long-run capital-to-income ratio doubles.
Wait, it doubles?
It doubles, from 5 years of national income to 10 years.
A structural drop in growth from 2% to 1% means the total accumulated capital stock becomes twice as large relative to the annual economy. That is huge.
It's a profound structural shift. The society becomes much more capital-intensive, and capital owners, as a group, control a vastly larger share of total economic resources relative to the labor economy. This is what brings inherited wealth roaring back to prominence.
If we apply this to a global scale, where the global savings rate stabilizes around 10% and long-term growth is at 1.5%, the global capital stock settles at around 6 to 7 years of income.
But if growth drops to 1%, that stock could rise as high as 10 years of income, massively shifting power toward capital.
So we see these primary structural forces, the RG inequality and the laws of capital accumulation, are fundamentally driving us toward divergence. But what are the counterweights? What forces push toward convergence?
The research identifies one primary force for convergence, one that historically has reduced inequality both within and between countries.
And that is?
The diffusion of knowledge and investment in training and skills.
This is the story of global catch-up, right? Previously poor countries, South Korea in the 70s, China today, they rapidly reduced the gap with richer nations by adopting advanced production methods and educating their populations.
It's the great equalizer between nations.
That sounds incredibly powerful, a true engine of meritocracy.
It is, but it's not spontaneous or irresistible. The diffusion of knowledge depends heavily on specific, sustained educational policies and adequate access to training.
So if you lack that sustained public investment, large social groups get excluded from the benefits of growth.
Precisely. And ultimately, this convergence force, which is sort of linear and driven by labor, it struggles mightily against the massive exponential compounding power of capital, which is fueled by RG. It's a race where one runner, capital, is constantly starting far ahead and accelerating faster.
The discussion so far suggests that if things were just left alone, capital concentration would simply keep growing. But the 20th century proves that the history of inequality is anything but tranquil. It's chaotic, it's intensely political.
That is the main takeaway from looking at the composition of capital over 3 centuries. The total value of capital, measured in years of national income, it didn't fundamentally change much. It hovered around 6 to 7 years.
Except during the single most volatile period, 1914 to 1945.
Exactly.
Let's briefly characterize that stable 19th century patrimonial society first. The world of Balzac.
In the 18th and 19th centuries, wealth was concrete and dependable. It was primarily agricultural land or highly stable government bonds.
And they reliably produced what were known as rents.
Yes. The traditional conversion rate was 5%. If you bought an asset, you expected to receive 5% of its value back in income every year, meaning the asset was worth 20 years of its annual income. That stability defined the rentier class.
Then came the Great Collapse of 1914 to 1945. The capital-to-income ratio in Europe just plummeted. This was a catastrophic pan-European deconcentration of wealth that completely reset the system. What were the specific causes?
The causes were these cumulative shocks. The research meticulously attributes the decline to two main categories. The majority, between 2/3 and 3/4, came from what they call volume effects.
So that's physical destruction from two wars, sustained periods of low or negative savings.
And the colossal loss of foreign assets.
That foreign asset loss must have been profound for the colonial powers like Britain and France, who had these vast global portfolios built up over centuries.
It was staggering. Their net foreign assets, which were extremely high before World War I, vanished. They were literally evaporated by the cumulative shocks, the wars, the Great Depression, and the geopolitical shift toward decolonization.
So by the 1950s?
By the 1950s, the net foreign assets of both countries were reduced to almost zero. It represented a permanent destruction of historic wealth.
The remaining portion of the decline, about a quarter, was due to price effects, real estate and stock prices being depressed. But one key tool governments used to manage the staggering debt from the wars was inflation.
Oh, inflation was an essential tool, chaotic and politically fraught, but essential. It allowed governments to implicitly default on debt owed to their own citizens.
What's the most dramatic example of this?
You have to look at Germany. To reduce the crushing public debt from World War II, they essentially used hyperinflation, though it was spread over 2 decades. Between 1930 and 1950, prices multiplied by a factor of 300. That's an average of nearly 17% inflation every year.
And this rapid, chaotic inflation just shrank their public debt to barely 20% of GDP by 1950.
It's an astonishing efficiency in debt reduction, but it's also easy to see why that trauma created the deeply ingrained anti-inflationist attitude we see in Germany today.
Right. The refusal to countenance price increases greater than 2% a year. It's a deep cultural scar.
And you can compare that to Britain, where public debt reached over 200% of GDP by 1950. They used a slower, more controlled version. Sustained inflation in the 50s, and especially the turbulent 70s, to slowly reduce that ratio down to 50% of GDP.
So inflation acts as this massive redistribution of wealth, essentially a hidden tax on bondholders and creditors, the rentier class. But you mentioned a critical nuance. Inflation doesn't reduce the average real return on real assets.
This is a point that risks being misinterpreted, so we have to be clear. Inflation is not a universal destruction of capital. Real assets like physical property, machinery, corporate equity, their prices rise along with consumer prices.
So the average real return on a portfolio of real assets stays relatively stable.
Correct. The main effect of inflation is redistribution, specifically penalizing those who hold nominal assets.
And who holds nominal assets?
Often the less wealthy or the cautious middle class who hold cash, fixed-rate savings accounts, or government bonds. The very wealthy, whose portfolios are heavily in diversified real estate and shares, they often weather inflation much better.
So while it was a political necessity for debt, its redistributive effect was often haphazard and sometimes hurt those who could least afford it.
The Great Collapse was a temporary phenomenon. Since 1970, we have seen a spectacular recovery of private wealth, especially in Europe and Japan. The capital-to-income ratio is back to pre-WWI levels. How is this explained?
It's that dynamic of AFNO in action. Europe and Japan saw their ratio jump from 2 to 3 years of national income in 1950 up to 5 to 6 years by 2010.
It's that combination of high savings rates coupled with slowing structural growth rates, a post-tronic lore uses reality that meant capital accumulated massively.
You can see the slowing GE everywhere. France and Germany, for example, saw their per capita output growth rates dip below 2.0%, which is significantly lower than those heady 1950-1970 peaks.
And this structural recovery means that inherited capital is absolutely back. The annual flow of inheritances and gifts in France, for instance, fell sharply during the collapse.
To less than 5% of national income in 1950.
And it had rebounded sharply to 15% by 2010. That's a threefold increase in the sheer volume of wealth being transferred between generations.
This shift is powerfully captured by what the research calls the Rastignac dilemma, named after the ambitious young man in Balzac's Père Goriot. It illustrates the competition between earned income and inherited wealth.
The Rastignac dilemma shows the inversion of the reward structure over time. In 19th century France, the system was overwhelmingly patrimonial. The top 1% of inheritors enjoyed lifetime resources that were 25 to 30 times greater than the resources of the lower class.
So inherited wealth was the dominant, overwhelming path to a comfortable life. And how did that compare to labor income?
Even the top 1% of labor earners, the best doctors, judges, lawyers, had resources only about 10 times greater than the lower class. Inheritance dramatically outpaced labor.
But the generation born during the collapse, say in the 1910s and 1920s, they experienced a temporary reversal of that dynamic.
Exactly. The shocks made capital less relevant. For those cohorts, the top 1% of inheritances afforded barely 5 times the lower class standard. Suddenly, work and skill acquisition were temporarily more rewarding than inheritance.
The top jobs still afforded 10 to 12 times the lower class standard.
It was this brief age of meritocratic hope.
But by the 2010s, the data shows the ratio is inverting yet again.
Yes. Inherited wealth is once again projected to provide a much higher standard of living than even top labor income. This doesn't mean we have returned to the exact 19th century structure, but the total volume of inherited wealth is nearly equivalent.
And the nature of the rentier class has changed. It's moved from a few very wealthy people to a much larger number of petits rentiers. We should clarify that term for the listener.
Petits rentiers literally means small rentiers. We're not necessarily talking about the ultra-rich, but a significantly larger fraction of the population receiving substantial, life-changing inheritances, maybe 200,000 up to 2 million.
These aren't amounts that let you quit your job necessarily, but they fundamentally change your financial trajectory.
Precisely. It's so much easier to save and accumulate your own capital if you inherit an apartment and you're debt-free, or if you receive a 6-figure lump sum to start a business. This substantial inherited wealth is crucial because it gives the receiver a massive head start in that RG race. It institutionalizes a deep inequality of opportunity.
While Europe saw the dramatic return of inherited wealth after 1970, another major divergence has been happening at the same time, centered largely in the U.S., the explosion of top labor incomes, dominated by what the research labels supermanagers.
This is a stunning divergence in the U.S. data. Since 1980, the top decile share of national income soared from about 30–35%, a level similar to post-war Europe, to 45–50% today.
Which effectively returns the U.S. to the same level of income concentration Europe had right before World War I.
And this massive rise is largely concentrated among top executives, CEOs, and financial firm managers. The source material argues that this phenomenon is not primarily explained by that classic economic theory.
The race between education and technology.
Right. If it were purely about technology increasing the demand for highly skilled labor, we would see this extreme executive pay explosion globally. But we don't. The pay hikes for supermanagers are far more extreme in the US and, to a lesser extent, Britain, than in continental Europe or Japan.
So the global market for technology doesn't fully explain the local market for CEO pay.
It doesn't.
Yeah.
So if it's not purely marginal productivity, the research suggests the major variable is social norms.
Meaning what, exactly?
At the very highest echelons of management, where the difference in actual productivity between a CEO paid $5 million and one paid $50 million is almost impossible to measure, the limiting factor becomes social and institutional tolerance.
But wait, isn't the standard economic counterargument that these executives are responding to a fierce global competition for talent? If a company doesn't pay its CEO competitively, won't that CEO just jump ship to a firm in Singapore or London?
That's the defense, yes. But the data suggests that social norms heavily influence what boards and compensation committees deem necessary. Executive compensation packages of several million euros are still viewed as significantly more shocking and politically unacceptable in places like Sweden, Germany, or France than they are in the US or UK.
So the institutional framework, the internal social politics of the corporation, and public tolerance for extreme inequality are the primary drivers.
Not just the global supply and demand for high-skilled labor.
Beyond labor income, let's look at global capital concentration. This distribution is consistently historically extreme.
The concentration of capital is always orders of magnitude higher than the concentration of labor income. The bottom 50% of the population, globally and historically, owns virtually nothing.
Typically less than 5% of total wealth.
Meanwhile, the top decile owns the vast majority, somewhere between 60% and 90% of all wealth.
We see this most dramatically in the rise of the billionaire class. Between 1987 and 2013, the number of billionaires per 100 million adults increased sixfold, and their collective share of aggregate private wealth tripled.
And we have to reject the myth that this is purely entrepreneurial wealth. The analysis of these largest fortunes suggests that inherited wealth accounts for well over half, likely 60% to 70% of the total amount of the largest fortunes worldwide.
The compounding effect of R1G means even brilliant entrepreneurs eventually hand off wealth that then compounds passively.
On the other side of global capital are sovereign wealth funds, these massive state-owned pools of money, often from petroleum states, China, and Singapore.
Right.
SWFs already hold about 1.5% of global private wealth, which is comparable to the total wealth of all billionaires combined in 2013. But their trajectory is unique.
They're fueled by reinvested oil rents and state surpluses, not just capital returns.
And because of that, it is highly plausible that SWFs could reach 10% to 20% of global capital by 2030 or 2040.
That represents an enormous shift in global ownership, moving wealth from private hands to state hands, often authoritarian states.
It creates a profound future geopolitical tension. Who owns the world's capital? Is it private individuals hiding their money in tax havens, or is it sovereign states that use that wealth for strategic goals? The rules governing these colossal funds will define international relations for decades.
And speaking of hiding capital, the data shows that tracking wealth in a globalized market is almost impossible. Official statistics paint a profoundly incomplete picture.
Yes. Officially, if you tally up all the cross-border assets and liabilities, rich countries collectively appear to have a slightly negative net asset position globally.
But this doesn't account for the financial assets hidden in tax havens,
Which amount to nearly 10% of global GDP. And that's a cautious lower bound estimate.
That 10% figure is startling. And who owns it?
The vast majority, at least 3/4 of it, belongs to residents of the world's rich countries, the US, Europe, and Japan. This concealment masks the true state of affairs.
The net asset position of rich countries is actually quite positive, but the wealth of their wealthiest residents is simply hidden from national statistics and tax authorities.
It demonstrates the enormous difficulty democratic states face in regulating capital globally.
Given these powerful forces of divergence RG, low growth, exploding supermanager pay, and untraceable global capital, the research moves decisively toward policy responses needed to reassert democratic control. Let's start with the progressive income tax.
Historically, the progressive income tax and the progressive inheritance tax were the foundation of the modern social state. They were only fully embraced in the US and Europe after the chaos of World War I.
When governments desperately needed new revenue sources and politically tolerable ways to manage massive war debts. Now, we need to address the most controversial finding regarding the top marginal tax rate. The research suggests that confiscatory rates, like those above 70%, which were common in the US and Britain during the mid-20th century, should return.
Yes. The analysis suggests rethinking the purpose of these high rates. Historically, the primary purpose of, say, a 90% marginal rate on the highest income bracket was not maximum revenue generation.
It wasn't.
No, these high brackets apply to such a tiny fraction of the population that they don't yield enormous amounts of cash.
So if it wasn't for revenue, what was the function of the 90% top rate?
It was a tool of political and social policy. The goal was to set institutional limits on incomes that lawmakers and society broadly deemed socially unacceptable and economically unproductive.
It was a way of establishing a social norm that executives shouldn't earn 100 or 200 times the average salary, regardless of what the board might claim about their marginal productivity. It was a ceiling on inequality.
That's the conclusion. Expert estimations suggest that the optimal top marginal income tax rate is likely above 80% for incomes over, say, $500,000 or $1 million annually.
And the research suggests this high rate would not reduce economic growth.
It would not, because productivity is driven more by shared knowledge and collective effort than by the personal incentive of the one individual at the very top. What it would do is powerfully limit the supermanager phenomenon and redistribute the fruits of growth more widely.
But the progressive income tax and inheritance tax primarily target flows or transfers. The research proposes a different tool as the most appropriate response to the fundamental divergence dynamic RG, which operates on the stock of wealth.
The progressive tax on capital or a wealth tax?
This is proposed as the most effective and liberal way to reassert democratic control over global capitalism while still respecting the institution of private property.
Right. It addresses the RG dynamic directly and is supported by two powerful justifications. First, the contributive justification.
What does capital being a better indicator of contributive capacity mean?
For the very wealthy, capital is the source of their power, but their taxable income often drastically understates their true economic capacity. The largest fortunes yield extremely high, steady returns. Remember, R is often 4 or 5%, but those fortunes are often accumulated tax-free within trusts or foundations.
So a rentier can live off this accumulation without reporting a massive taxable income.
A tax on the total stock of wealth captures this actual capacity to contribute to society more accurately than income tax alone.
And the second justification is the incentive justification, which is a clever way of using the tax to promote efficiency.
It's highly liberal in its intent. A small annual tax, say 1% or 2% on total wealth, is intended to incentivize the efficient use of that capital. For a dynamic entrepreneur earning 10% on their investments, a 1% wealth tax is a light obligation.
But for a pure rentier, content to just park their wealth in passive low-risk assets yielding only 2% or 3%, a 1% tax is a heavy burden.
It forces that rentier to either find a more dynamic, socially useful investment, or to sell the asset to someone who can utilize it more efficiently. It pushes capital out of the hands of the passive holder and into the hands of the dynamic investor.
Let's look at the sample schedule proposed. 0% on fortunes below 1 million. 1% between 1 million and 5 million, 2% above 5 million. How significant would the revenue from such a tax actually be?
If you applied that across the European Union, this schedule would only affect about 2.5% of the population, but it would bring in revenues equivalent to 2% of Europe's GDP annually.
That's a massive amount of revenue.
It is, and is comparable to the historic use of exceptional capital levies, like the 1945 tax in France, which had rates up to 25% to drastically reduce public debt.
The history seems clear. The most substantial reduction in inequality resulted from the catastrophic political and economic shocks of the mid-20th century, not from some tranquil, self-correcting market mechanism.
Exactly. The fundamental long-term logic of RG drives divergence, and it's exacerbated by slowing global growth and unequal returns on capital. The spectacular recovery of private wealth and the return of inherited capital necessitate new, robust, regulatory responses.
Relying solely on economic growth is incapable of satisfying our democratic and meritocratic hopes.
You need institutions, like a robust social state and globally coordinated progressive taxation.
And speaking of things we worry about, the research suggests that our modern fixation on public debt is misplaced. It's distracting us from far larger challenges.
Public debt, while it's important, is small compared to total private wealth, and has historically been managed through various means, including growth and controlled inflation. The truly urgent and difficult challenges are monumental.
Like
increasing educational capital globally to combat inequality through skills, and preventing the degradation of our natural capital, specifically climate change. These environmental and human capital crises require vast, coordinated investments.
So we've outlined a chaotic, data-driven history. We've identified the fundamental economic law driving divergence, and we've discussed a clear institutional response in the progressive tax on capital.
Which brings us to the ultimate question for you, the listener. It's a question that moves beyond economics and into the realms of political science and culture.
If a progressive tax on capital coordinated globally, respecting private property, and offering both distributive justice and economic efficiency is identified as the most effective tool for reasserting democratic control over capitalism, what deep non-economic forces, social, political, or cultural factors are currently preventing its serious implementation on a global scale?
What makes us so collectively resistant to taxing the compounding power of inherited wealth? That's what we leave you to mull over.
Until next time, keep digging into the data.